In this class, we're taking Cambridge question for May-June 2019. Question 4, basically. So get my textbook or study pack. Okay, is 7,000 naira per copy or $12 US. You can sponsor copies or gift people for 6,500 naira or 11.5 US. So Cambridge IGCSE May-June 2019 question 4. So here we have Liam and Maya are in partnership. Okay, the financial year ends on 31st January. They share profit and losses in the ratio 2:1. The following information is available. So we have Liam, we have Maya. Capital account at 1st February 2018. Liam is $160,000. Maya is $60,000. Current account as at 1st February 2018. Okay, we have Liam to be $44,500 credit dollars, then Maya to be $2,140 debit dollars. So the drawings during the year ended at February 2019. We have $19,100 for Liam, $8,500 for Maya. On the 1st August 2018, Liam transferred $14,000 from his current account to his capital account. On the same date, he transferred his personal motor vehicle valued at $6,000 to the business. The following is an extract from the profit and loss appropriation account of Liam and Maya for the year ended at the 1st January 2019. So we have Liam and Maya, extract from profit and loss appropriation account for the year ended at 1st January 2019. We have the profit for the year 240. Interest on drawings, Liam is 955, Maya is 425. Interest on capital, Liam is 10,200, Maya is 2,600. We have 13,800 altogether. Salary to Maya is $15,000. So total we have 28,800. So the difference there is a negative of $3,180. So here they are saying required: A, calculate the percentage rate of interest charged on drawings. And then we have another one, they calculate the percentage rate of interest allowed on capital. So we have various questions required from this very business of Liam and Maya. So we're taking it one after the other. So the first one there, we have the business is Liam and Maya. So we have Liam and Maya. So the first requirement there, say we should calculate what? The percentage rate of interest charged on drawings. Okay? So we have percentage rate of what? Interest on what? Drawings. Remember, partnership. Okay? You can visit jadosconsulting.com to take the full class, okay, on partnership. Is there. And then now, remember in partnership, usually based on the agreement of the partners involved in the business, there's usually interest that is charged on drawings made by individual partners. So we agree the percentage. Basically, it can be whatever percent, 5%, 10%, whatever percentage agreed by the business. But this question here is not telling us the percentage that has been agreed, but the question gave us the value that was charged as interest on drawings. He also gave us the drawings actually charged. But now it's telling us to calculate the percentage that has been agreed by the business. So basically, we can just use our simple accounting equation or mathematical equation to derive the rate of what? A percentage of interest charged on what? Drawing. So basically, we can say for what? For Liam. Okay? So basically, interest on drawings, okay, is, we can say X% of drawings. Okay? Now, they are telling us that the X% of what is the drawings now in the question? The drawings made by Liam is 19,100. So X% of 19,100 is equal to what was the drawings charged in the profit and loss appropriation account for Liam? 955. So we have 955. So basically, X percent of 19,100 is equal to 955. So we can say X over 100 times what? 19,100 is equal to what? 955. So we can as well say 19,100X over what? 100 is equal to what? 955. So basically, if we cross multiply, 1900x will be equal to 955 times what? 100. So 19100x will be equal to what? 95500, which is $95,500. So our x, which is the percentage we're looking for, will be equal to what? 95,500 over what? 95,500 over what? 19,100. So what we have, we can use the calculator there. So basically, if we say 95,500 divided by 95,500 divided by 19,100. Okay, so I have what? 5%. So if you want to check, so you can just say 5%, okay, of what? $1,900. That will give you $955. Okay, so basically what we've done here is to use the figure supplied to achieve the interest on drawings. Okay, so the next one there we have MEA. So let's go for MEA. Okay, so we have interest on drawings as usual. That would be what? X% of what? Of drawings made by MEA. So what is the drawings made by MEA? That would be X over 100 times what? Drawings made by MEA. According to the question, drawings made by MEA is 8,500. So we have 8,500. So that will be equal to, okay, what is the value of drawings that the question gave? Interest on is 425. That will be equal to 425. Okay, so that means X over 100 times what? 8,500 is equal to what? 425. So basically, you can say 8,500x over what? 100 is equal to what? 425. So basically, if you cross multiply, 8,500x is equal to what? 425 times what? 100. So that means 8,500 what? X will be equal to what? 42500. So that will be 42,500 there. Okay. So what do? Divide both sides by 8,500. So X will be equal to what? 42,500 over what? 8,500. So what's your X? So basically, using our calculator there, we have what? 42,500 divided by 8,500. That is also 5%. So if you're checking that, you say 5% of what? 8,500. Okay. That should give us 425. Okay, so that is it for the first question. The next one say calculate the percentage rate of interest allowed on capital. Just the same way, we're taking the same approach here. Okay, so this is Liam. So it now be interest on capital, the same thing, X% of what? Capital contributed. So what is Liam's capital? According to the question, Liam's capital is 160,000. So we're going to say X over 100 times what? 160,000 equal to how much they give. They supplied in the extract there. Interest on capital for Liam is $10,200. So that would be equal to $10,200. So basically, X over 100 times $160,000 equal to what? $10,200. So basically, 160,000 X over 100 is equal to $10,200. So basically, if you cross multiply, 160,000 what? X will be equal to $10,200 multiplied by what? 100. So that means your 160,000 what x will be equal to what 10,200. Then that will be I'm seeing there 1,020,000. So x will be equal to 1,020,000 over what 160,000. So what do you have there? So we have 1,020,000, okay, divided by 160,000. So I have 6.36%. 6.36%. The question specifically said that we should calculate it there, calculate the percentage rate of interest allowed on capital there. So we've done that, which is 6.36%. That's 2 decimal place. If you want to make it 1 decimal, that'll be 6.4. Okay, so that's it now for Liam. So if we're doing for Mia, the same way, interest on capital now, x% of what? Capital. I already explained the approach. That will be what? X over what? 100 times what is the capital contributed by Mia. Question says $60,000. That will be x% of $60,000 equal to what is the what? Interest on capital shown in the what? Appropriation extra there. I can see 3,600. That will be equal to what? 3,600. So basically, we have what? 60,000 what? X equal to what? 3,600 times what? 100. So 60,000 x will be equal to what? 360000. That's 360,000. So x will be equal to $360,000 over what? $60,000 there. So what do we have there? 360, okay, 1,000 divided by what? 60,000. So I can see there 6%. So basically, if you're testing that, say 6.36, okay, 6.36, okay, percent, okay, times 160,000. Okay, so that we have approximately 10,200. You can see 10,100, that's approximately. And then we have the 6% here of 60,000 there, which should give you, okay, of 60. That'll be 3,600. So basically, approximately is 6%. Okay, if you want to round it up, that is without decimal place, this is 6%. This is also 6%. So 6% of 160,000 will give you 10,200. 6% of 60,000 will give you 3,600. So that's the question, saying we should calculate the rate of interest on drawings and the rate of interest on what? Capital. So the next question there, B, is saying that we should what? Complete the current account of the partners for the year ended at February 2019. Okay, balance the account and bring down the balance on February 1st, 2019. So they're giving us, you know, a form of the table, the way they want the table to look like. So I think that is IGCSE's approach. They will normally guide you on, okay, how they want you to prepare the account. So they're giving us a sort of format that we should follow, so which we will do right now. So let's take this off. Okay, remember you can visit journalistconsulting.com to take your full class on partnership. That should be good to help out there. So if we are taking this based on what has been supplied there, I can see Liam and Mia. Okay, so I can see current account. This is based on what has been given to us, so we're following the format given. Okay, so the first thing there says date. So we have dates, details. We have Liam and Mia. Liam, then we have Mia. So it's all given in dollars there. So here we have dates, details, Liam and Mia. So we have dollar sign, we have dollar sign, dollar sign, dollar sign. So this is how the table has been presented by the examiner. So this is not new, this is debit, this is what? Credit. So basically there I can see February 1st, 2018, okay, 2018, I can see balance brought forward there. Balance brought forward there for Mia 2,140. The question is saying that Mia has a debit balance. Then the same date there, 1st February 2018, there's a balance brought forward there for Liam. Liam is having 44,500. You can get all this in the question. So this is how the question, they supply this to us, and they are telling us to prepare the current account based on this table. So let's go. Remember, your current account information, okay, usually your current account is a fixed capital. Basically, if there's an excess you don't want, based on the agreement, to go to the capital account, take it to the current account. So we have what we call fixed capital and floating capital accounts. You can take your class on partnership in jadusconsulting.com. So let's proceed based on the question here. So here we have the current account balance that has been taken. Now we have drawings. Usually when the partners take money out of business, it reduces their what? Their current what? Account. Okay? So we debit them with that. So here we have on the 1st of drawings, yes, 31st January 2019. I can see 19,100 for Liam. Mia here, I can see 8,500. Okay, so we can simply say let's say the last date of February there, or let's just say 31st January 2019. Okay, so we have drawings. Okay, Liam withdrew how much there? Liam withdrew 19,100. So we have 19,100. Mia withdrew 8,500. Okay, so what's the next thing that should go to the current account there? They said on the 1st August 2018, Liam transferred 14,000 from his current account to his capital account. Okay, so we're going to have, what's the date there? August 28th. So let's say there is what they call a capital account transfer there. Okay, capital account transfer. Liam is taking out 14,000 from his current account. So we have 14,000 debit here. That will be credited to his capital account there. Then the next one there, on the same date, he transferred his personal motor vehicle valued 6,000 to the business. So now he's bringing his personal vehicle to the business. That will be like a credit. Okay, so we have date there, August 1st, 2018. Okay, so we have 2018 motor vehicle. Okay, Liam is taking his personal vehicle to be $6,000 to the business. So we have $6,000. So basically, if you brought in cash, you would have been credited with it. okay? Or in this case, brought in his vehicle valued at $6,000. So you credit his current account and then debit motor vehicle of the what? Business. Okay? In the case of capital that he brought into the business, okay, in the case of capital that he brought into the business, okay, what do? You debit motor, you debit his current account with the capital amount and credit the what? Capital what? Account. So what's the next thing that happened there? I can see that is it. But then there is a share of loss based on the extra given. What about salary? I can see salaries. I can see interest on drawings. So let's go. Interest on drawings is what? It is a payment from the perspective of the business. Okay. From the perspective of the business, it is a payment from what? The partners to what? To the business. So that is more like what? An income to the business. But then to the partners, it is what? It is a debit. That's an outflow, more like an expense. So we have interest on what? On drawings there. Interest on drawings. We have that of Liam to be 955. 955. Mia to be 425. 425. Okay. Then the next one, then we have interest on capital. Okay, so the interest on capital there is like saying, okay, for you putting your money in the business, it will attract some what? Commission, some interest or no annually. So this interest there, we have Liam. So that's more like so we can use the last date. Okay, so let's use the last date. So the date is not okay, but then let's just go on. Okay, so we have interest on capital here. Liam here, according to the business, we have Liam having interest of 10,200. 10,200. Mia having interest of what do we have there? 3,600. 3,600. We also have salaries. Mia is getting, I guess Mia is more like an active partner. Yes, Mia is getting a salary of $15,000. So we have salary to Mia, $15,000. And then we have, there's a loss there. I can see a loss there. There's a loss there because the profit for the year is 24,240. Interest on drawings 1,380 in total. That's 25,620. Interest on capital, Liam is 10,20, 10,200. Mia is 3,600. That's 13,800. Then salary to Mia is 15,000. Everything is 28,800. But then the profit or income that came to the business in a proportional perspective is less than what is being paid to the partners in terms of commitment of the business to the partner. So we have 28,800. So there's a negative of 3,180, which is more like loss that is going to be shared among the what? Partners. So let's go. So let's say share of what? Loss, which is, what's the loss that according to the question? $3,180. $3,180. Okay. So what is the ratio for sharing profit and loss? The question ratio is 2:1. So we have Liam, which is 2, Mia, which is what? 1. Okay. So that means Liam will be 2 over what? 3 times, what's the loss there? 3,180. Mia will be 1 over 3 times 3,180. Okay. So what do we have there? Let's use our calculator there. Okay. 2 divided by 3. Okay, times 3,180. I can see 2,120 for Liam. Okay. The 1 divided by 3 there times 3,180. I can see 1,060. So total there, if we check, plus 2,120, that's 3,180. So there's a loss apportioned to 3,101, 219 share of loss. Okay, that's a debit in the account. So we have Liam to be what? 2,120. Mia to be what? 1,060. I guess that's all according to the question. we've treated current account balance, they will give us that. Drawings we've treated interest on drawings, we've treated interest on capital, okay? And then we've done share of loss, we've treated salaries and all that. So let's balance the account now. So we compare the debits of the current account of MIA against the credits to know if it's a debit balance or a credit balance. The same thing for what? For Liam. So let's go for Liam. Let's start with Liam here. This is the credit here. Credit here we have 44,500 plus 6,000 plus 10,200. That's 60,700. 60,700. Okay. And what's the total here? We have 19,100 plus 14,000. Okay, plus 955 plus 2120. So we have what? 36,175. So what's the difference? Okay, so we have 36,175. Okay, what I have 24,525. So the balance, excuse me, okay, the balance carried out here would be what? 24,525. So both sides would be what? 6,700. Okay, 6,700. So there's a balance brought down here to what? 24,525. So basically, Liam has a credit balance at the end of the year of $24,525 for dollars. So let's go for Mia. Mia, I can see 15,000 here. 3,000. That's 18,600. 18,600. So what do you have at the debit side here? I have 2,140. Okay, 2,140 plus 8,500 plus 425 plus 1,060. So I have 12,125. So the difference here, okay, is what? 6,475. So there's a balance of 6,475 here to give us 18,600. We have 18,600. So we have 6,475. So what this is telling us is that at the end of the year, Liam is having a credit balance of 24,525. Mia is having the what? Credit balance of what? 6,475, all in dollars. So that is it for the requirement B there. So requirement C, I can see requirement C there. They are saying that what? Liam and Mia provide the following information at 31st January 2019. So they're giving us inventory 38,440, trade payables 38,250, trade receivables 42,060, bank overdraft 14,150. Let's say calculate the current ratio. Okay, the current ratio there. So what do we do? Let us based on the question this is going. This is requirement C. Okay, requirement C, it seems to calculate what? Current ratio. Remember your accounting ratio. You can take your class on accounting ratio on jadosconsulting.com. Okay, so what is the formula for current ratio? Current ratio is your current assets divided by what? Current liability. So based on the question, what are the current assets in the question? So your current ratio will be equal to, we have inventory. Inventory according to the question is 38,440. we have 38,440 plus what other current asset item do you have there? I can see trade receivables of 42,060. 42,060. I think that's about the item. And then we have all over. What are the current liability items there? We have trade payables 36,250. 36,250 plus what do you have there? Bank overdraft 14,150. 14,150. So what do you have? Okay, 38,440 plus 42,060. Okay, that's what? 80,500 all over. What do you have there? 36,250 plus 14,150. 5,400. So what do you have there? So if you say 80,500 divided by what? 5,400. So I can have, I see 1.6 to ratio what? 1. So that means the current asset is 1.6 times higher than the current liability. Business is 1.6 times, okay, capable to what? Settle its what? Current liabilities within the what? Period. So that is it for that one. And then they say calculate the quick ratio, the acid test ratio. You should go to, so this is CI, so let's say CII. They say we should calculate what? The quick ratio, also called acid test what? Ratio. So if you go to jarosconsulting.com, you can take the full class on what? Accounting ratios. So basically, what we normally call quick ratio is to say, we're saying that in order to meet the obligation of the business, okay, what is the ability of the business to quickly turn its items, okay, to quickly meet it up, that is without having to what? Chase sales. What that ability? So what we do is it's still current assets over current liability, but in this case we take out inventories because we believe that the inventory of the business we cannot sell it at that point of time when we're reporting. So if we take that out, all other ones are liquid. Okay, so quickly we can resolve obligations without having to what? Chase selling of what? Products. Okay, except of course in practical terms you can justifiably, or you can reasonably justify that what? That you can actually, you know, make sales from inventory. Then that one you are not going to say it's part of what? Quick ratio. But theoretically, okay, it is assumed or believed that inventories or stocks cannot be quickly turned into what? Cash. Okay, though we have some things that can happen in practice where you can try to, you know, use those as justification to what? Interpret your or to defend your decision. But according to this question, let's not make it complicated. We are going to say that quick ratio is what? Current assets, okay, minus inventory, okay, all over what? Current what? Liabilities. Okay, so what are our current assets in this question? 80,500. What's our inventory? 38,440. 38,440. All over. What's our current liability in the question? 5,400. So this is the same thing as what? 42,060 all over what? 5,400. So what do you have there? What do you have there? So we say 42,060 divided by what? 5,400. So this is what? 0.8 to ratio what? 1. So the business is less than 1 times, okay, capable of meeting his what short-term obligations. What I was saying is that if assuming we cannot make sales out of inventory, how capable is the business able to meet its short-term obligation? So theoretically, current ratio is 2:1. If the business is twice, if business is 2 times capable of what settling its short-term obligation, we'll say the business is doing well. But here is 1.6, fairly. But theoretically, quick ratio should be 1:1. But here I can see it's about 0.2%. About 20% less. Okay, but then now we have there 0.8 to 1 instead of 1 to 1. So that is it for that requirement there. Okay, so this is C. C is current ratio. D is quick ratio or acid test ratio. So the next one there, they are saying that Liam and Mel would like to improve the liquidity of their business. They now say that Liam has suggested that both the current ratio and the quick ratio could be improved if they introduce extra cash. So they're not saying that I should suggest any other way which they could increase both the current ratio and quick ratio. Which other way? Definitely, if our current ratio, I'm answering the question, so you can just take your notes. If our current ratio is current asset over current liabilities, it means that cash is part of current asset. So if you introduce additional cash, okay, let's say you introduce additional cash here of, let's say, 30,000. So that means this will increase. Let's even say 20,000. If you include additional cash here of 20,000, that means our current asset will increase to 100,500, which will also increase our what ratio. Okay, so if we are testing that, assuming we're introducing $20,000, so that means current ratio here will be what? 100,500 over what? 50,000 what? 400. So what do you have there? So we say 100,500 divided by what? 50,400. Okay, so that will improve current ratio to what? 1.2, approximately 2:1. So that will increase. I'm saying 1.99, so that's about 2:1. So that means that if we introduce additional cash, that's capital, which will be in cash. Okay, if you introduce extra capital, will be in cash. If you bring cash as capital, current asset will improve. So if we are introducing $20,000, for instance, current assets will now increase to what? 100,500. So in that case, our current ratio will improve from 1.6 to what? 2:1. The same vein, if we come here, okay, if we come here and then improve our what? Quick ratio by the same cash increase. Oh no, so it will now reduce from what? 100,000 to what? If you put 20,000 on this, now that will be 62,060. That will be 62,060 over what? 50,000 for what? 100. So that will improve what? Our what? Quick ratio as well. You know, when we say 62,060 divided by what? 5,400. So that will improve our ratio to about 1.22 ratio what? 1. So that means it will make the quick asset ratio to be, you know, better. That means the business is more than 1 times capable, you know, to meet its short-term obligation. So basically, if you introduce additional cash as capital based on the suggestion of the partners, definitely current ratio will increase, quick asset ratio will also work. But they are not telling us. They said what? Suggest any other way which they will increase both the current ratio and the quick asset test ratio. It's a function of current assets. So long as your current assets is improving, you're having more cash. Basically, if you have more cash, it will definitely improve your what? Current asset. But that is more liquid compared to other what? Current asset items. So how do you get more cash? Aside from introducing extra capital, if you have assets, equipment that are not utilized, that are idle, you can sell them, dispose idle what? Asset items, and then bring the cash into the what? Business. That will improve your current asset as well, and that can also improve your what? Your current ratio or your quick asset ratio. So basically what we're saying is that the way to attempt or handle that challenge, which is in form of question here, is to think of items that will improve or increase the cash position of the what? Business. Do you understand? So aside from selling or disposing idle assets, in Nigeria, for instance, there are some grants that the government and some very good organizations usually give to businesses. For instance, in Nigeria, due to COVID-19, there's what we call the Survival Fund that the federal government introduced through its Ministry of Trade and Investment. Okay, businesses, especially small and medium enterprises, were able to access various forms of grants. A typical one I can give to you is the payroll support, where the government is helping the business pay its staff, 10 of its staff, minimum of 3, between 30,000 and 50,000 per staff for 3 months. So we're saying that all things being equal, you can have 1.5 million as an injection in form of what? In form of free grants from the government, or 900,000. Yeah, that's the way it is. If you don't have money to pay your salary, you're going to accrue for it. So basically what will happen? Your what? Your accrued expense will include which will improve your liabilities here. But we're saying that the government is telling that come and collect money and pay your salary. So it means that what? You're having free cash. So that can as well improve your cash. There's a way you can manage it such that what it will also improve your what? Cash. If you're able to access. There are other aspects of the grant, not necessarily payroll support. There are other grants, okay, that are given to support the business. One-off. There are some other business organizations as well that, in fact, some banks give very low risk assets. What I'm trying to say is loans. You know, from the bank perspective, it's an asset because when they give you loan, it becomes an asset to them because they are going to have to use it to make money by charging interest. But here, they are giving you at a very little or no interest at all. Imagine the bank giving you 100,000 to pay over 12 months. You know, at a very interest of maybe a very low interest of maybe 5,000 naira. So you're using 100,000 to pay 5,000 naira. So if they give you 100,000 in 1 year, you're paying 105,000. Now imagine what you can do with 100,000 naira in a month, so that you can get enough money to pay part of the interest. So what I'm saying is that think of things or items or steps that you can take, strategies that you can take to improve the cash position of the world. Because once you improve the capital of the business, you are technically improving what the current assets, the current ratio or the quick asset ratio. So that's it for that one. So the next one there, they are saying that states why selling inventory at cost price would what? Increase the quick asset ratio but would not affect the current ratio. But that is not a big deal. Remember that our stock or inventory is reported at cost, except we want to bring in the provision of the IS2, which is talking about comparing cost with net realizable value. That's not the argument here. Even if we do that, we might still end up having the same data. But then let's leave that out and go according to the requirements here. They are telling us that we should state why selling inventory at cost price will increase quick ratio but would not affect the current ratio. That is the way it is. The stock, which is inventory, is 38,440. Okay, it's 38,440, and it's still the same stock we are using in what asset test ratio here. So what we are now asking you is that if you sell at this cost price, it will not have any effect in current ratio, but it will have effect here in quick ratio. Why? Because of the fact that in quick ratio we do not include what? Stock. So if you sell it at cost price here, this stock will what? Become cash. So if for instance we sell everything here, which is 38,400, it will become cash, and then it will mean that the current asset minus inventory will be 80,500, which will make our what? Asset test ratio to change to 1.6 to ratio 1. Because we have sold the stock at cost price, and that will not make cash available. Remember, your quick ratio is current asset minus stock, so there's no stock again. Cash, it becomes cash. That will form part of the what? The formula. But if you do the same thing here, whether you include stock or not, do you understand now? Whether you change this stock to cash or leave it as stock, it will still be the same thing because your current asset ratio takes all the current asset items into consideration. So what we're saying is, if you sell the stock at cost price, it will have no effect in the current ratio because all your current asset items include stock. But if you sell at cost price, quick asset ratio will change because you do not include stock item. And because you have sold at cost price, it will have turned into cash that will form part of the what? Current asset. So the next one there, they say they say Liam and Mia are considering inviting their brothers, Darren, to become a partner in the business. Suggest 4 factors that they could consider before inviting Darren to become a partner. What we're saying here is that you want to bring a new partner into the business, admission of a new partner. So what are the things you're going to consider? There are various things you're going to consider based on the agreement between the old partners and the new partners. Okay? But generally, the new partner must be of the same mind, because you're going to have to bring this person in to be involved in what the system thinking, design thinking, critical thinking of the business, especially except if you say that he's going to be more of a nominal partner, that you don't need him to be actively involved. But aside from that, you cannot go into business with what? With an insane person. He must also not have any case of what? Of being bankrupt or restricting him from joining any business by any reputable court of law based on what the rulings of a particular country. Okay, so aside from that, you must also consider the fact that he is capable of contributing his part, either in form of cash or assets to the business. And then sometimes you can also look at the fact that the person has some goodwill. At least when you bring them into the business, okay, his popularity or his fame or whatever can help bring business transactions to the business. So you can also look at that. And then you also look at your business perspective too. What about your business? Is it capable of generating enough revenue to also pay him, so that we don't get selfish here? Healthy thinking. Do you understand? So you look at all those things that a same business will look at when bringing in partners into the business. So on your own, you can think of some items or some key points that you should look at when bringing a new partner into the business. You can also look at some other key points on your own on how to improve the current asset ratio and the quick asset ratio as well. This is basically a class on Cambridge IGCSE exams, so we were able to look at partnership here, and then it also has questions on accounting, which we were able to treat. So basically, it has some element of incomplete record as well, which we use when we have to get what we want. So if you have questions, you can drop questions in the comment section, or reach out to me on the number displayed on the screen. Okay, I'll be there to reply with the right answers. You can also order my textbook, okay, or support the course, okay, by donating or be benevolent, okay, at your will, basically. Thank you.